Hi, my name's Tony Suick. I'm a financial advisor, and I'm one of the partners here at Lifetime Retirement Partners. I'm here today to present to you our monthly market and economic framework. I do this once a month, and we kind of go through an overview of coming from, in this case, June. What did June look like in the stock market? What's our outlook for the coming months? And so we talk about economics a little bit. We talk about the investment markets a little bit. And I try to keep it as short and tight as possible. The target's usually around 15 minutes. So my goal is to give you the best understanding of economics and of the stock market, relevant items that I can in about 15 minutes before I let you go. In the interest of time, I usually jump right into it. And so just a couple quick disclaimers. Everything that I cover today is going to be available on our website. And so you can find a copy of this. Aside from the YouTube video, you can download all the slide deck, other information that we might look at today. Everything's available on lifetimeretirementpartners.com. You can sign up for a mailing list and start receiving this in your inbox every month. And along with other presentation materials and other items that we prepare over the course of the month. Once a quarter, I also do a long form economic discussion. And so I hope you'll, if that's of interest to you, I hope you'll come back and join me in that. We'll publish that in the next couple days. And so in June, we saw a pretty mixed bag in the stock markets. The Dow Jones was up a little bit, 2.5%. Pretty good for a month. The Nasdaq was down almost a corresponding amount, minus 2.81%, and a lot of that had to do with the end of the month, a bit of a rotation out of some of the chip stocks and some of the things that had been working prior to month had been working all year. The S&P 500 is down 1.1% for the month. Of course, it's after monster gains in basically since the end of the Iran conflict in April and May. We've seen big gains there. The Russell 2000, I'll talk about a little bit today, up 3.6%, continuing its huge run. I think they're saying now is the best 6-month run small cap stocks have ever had. Gold down 12% for the month, and crude oil down even more, 20% for the month. Not a good time to be in commodities, but again, we saw some weakness in the stock market too, and a lot of that had to do with probably just some profit taking and some rotating into other sectors, from one sector into another. And so a little bit of a negative performance in the stock market in June. I like to break things into quadrants when I try to picture the entire economy. We have macroeconomic indicators, strength of consumer, monetary indicators, and then market fundamentals. And market fundamentals, I'll come to more in a minute. I don't like to assign that some kind of firm score that says, yes, buy stocks right now. We just say kind of in what direction is it leaning? And I think we're still in a fairly positive environment for stock continued appreciation. I'll highlight mostly as I go through the next 10-15 minutes what has changed over the last month. Macroeconomic indicators was at a +2, has dropped down to a +1, and the changing variable was really new housing starts, where we had seen that actually increasing several months in a row earlier in the year. Then in April and May turned negative again, and that's dragging that score down a little bit. Most of the other components are still positive, and so I'm not really worried about the state of the macro economy, but it's not to say there aren't any headwinds. Strength in consumer moved from +1 up to +2. That actually was negative at the start of the year, and a lot of that has had to do with the strength of the labor market. And that's one of the things I'm going to highlight a little bit today is the employment market, I think, is a lot better than it seems to feel to people. So we'll go through a couple of data points on each of those. Now, my starting point when we always do this is to go through and talk about stock market fundamentals for a couple minutes. And that starts with price to earnings ratios. And the quick idea is, if you're not familiar with them, you have Apple at X dollars a share and Amazon at Y dollars a share. The two numbers don't have anything to do with each other because one stock might have a completely different number of shares issued. And so you have to break it down into comparable ratios. And that's what a price to earnings ratio is. You take the price of a stock, divide it into what it earns, and you end up with the comparable ratio. I'll mostly talk about the S&P 500 as we usually do, but I do want to point out the Russell 2000 first. 1st, right there in the middle. Current 39.27. Which is just the ratio. So the Russell 2000 is the small company index, right? Basically, the 2,000 small and mid-sized companies in America that generally aren't covered by the S&P 500. And so you see, like I said, those stocks have been on an amazing run. Technically, they're starting to get really expensive. We've been fortunate in the sense that we've been overweight on small company stocks so far this year. I'm not sure if that's what we're going to plan to do going forward. The S&P 500, you can see is only slightly more expensive than it was 1 year ago. So even with the recent stock market rally, remember that was starting from a little bit of a valley because we had seen a sell-off to start the year, followed by an amazing run. So on a current basis, which is taking the corporate profit for the last 12 months and saying, okay, if I, of course you're doing it for 500 companies, but if I took my profit for the last year, divide that into the stock price, it's almost the same as it was a year ago. We really haven't seen significant appreciation on the current earnings. Even better on a forward-looking basis, 21.47 is actually one of the lower recent values. What that tells us is that stocks have gone up in price, but not even as fast as their future expected earnings. Now, if we ever get to a point where they're not meeting those future earnings, then we have a problem. But we just went through a monster quarter. One thing I want to talk about a little bit today is stock valuations, meaning what do stocks correlate with when they go up and down, right? Because stocks can go up and down for all kinds of different reasons, but in the long term, they have to correlate against something for it to make sense. And that's generally going to be their corporate profits, both past corporate profits, but more importantly, expectations for future profits. And so we go through this earnings season where every 90 days, most companies announce, here's how we did this quarter, here's kind of our outlook for the next quarter or the next year. And how do those announcements line up with what was expected before the announcements? Well, we've been through one of the biggest quarters that we've ever seen in terms of this quarterly earnings season. And so if you look on the right-hand side, 2026 quarter one, 80%. So we're looking at gross revenue and earnings per share, which is essentially net revenue. Depending on why you're investing in a company, you might be interested in either. A lot of people are looking for gross revenue growth, but you might also be looking for just general profitability, and are those metrics improving? Both are good reasons to consider stocks. 80% of companies overperformed on a gross revenue manner in 2026 quarter one, and the average overperformance 1.8% was in line with the history of the last 5 to 10 years. 84% of companies overperformed on an earnings per share basis, one of the strongest numbers we've ever seen, and an even bigger blowout below that. You can see the historical average earnings per share overperformance last 5 years, 7.3%. This quarter, I should say, that we just came out of, 18.2%. And so we've seen a huge overperformance in corporate earnings. And that's one of the reasons we saw stocks rally and get cheaper at the same time. That inset graph right there is the S&P 500 forward PE ratio weekly since mid 2024. And all I'm looking at is at the end of it, you can see it actually kind of trails off, where even though we saw stocks skyrocket, earning on a future earnings basis, they've actually gotten cheaper over the last couple months. And I'm trying to demonstrate kind of the same thing right here, where we look at current versus forward price to earnings ratio. And the takeaway that I develop is that we've seen stocks get slightly more expensive over the last 2 years on the orange line, which is the current PE ratio. We've actually seen them come down in price on the price to earnings forward ratio. So it depends on how you want to value stocks. If you want to base them on what they made in the past, they've gotten a little more expensive. If you want to base them off of what they're expected to make in the future, they've actually gotten a little cheaper over the last 2 years, believe it or not, because earnings have been so good and so strong, especially over the last year. And so stocks tend to correlate to earnings season. This is what I wrote, and I'm just going to read it quickly. June 1st, when we were looking at a huge April growth, huge May growth in the stock market. And I said, while the recent stock rally is technically justified, it'll be difficult for stocks to maintain their recent rally until the next earnings season begins in July. Until then, we're likely to be in a window of increased volatility, markets which will be more sensitive to price pressures, oil, inflation, and headline news than they were in May. And I think that's exactly what we've gotten. We saw that little bit of stock weakness in June with a small decline in the S&P 500, a somewhat larger decline in the Nasdaq index. Um, and so the basic calendar is around mid-April, is when the last earnings season began, carried us for about 2 months into the first part of June. But then we're in this dirge where there's no earnings announcements, and it's the carousel starts again in the middle of July. And so right now we're still in this kind of gray area where, remember I said that stocks tend to correlate most to earnings announcements over time? Well, there are no earnings announcements right now. Those start again in a couple of weeks. I think we might still be in kind of a sluggish stock market. My general expectation is we're going to be in for another really strong earnings season to propel us another leg forward. That may or may not be true. I'll come back and let you know next month if I was dead wrong. But that's what we're looking for, is maybe a couple more wishy-washy weeks where the market's trying to decide what direction to go, probably rotate out of some things, rotate into some things, and try to position for that next earnings season. I'm going to skip around a little bit here because I don't have a ton of time left, and I do want to cover a couple of key things. Like I said, I want to go back to what is strong in the economy, what has changed in the economy, and I mostly want to talk about unemployment rates, and just I guess the labor market more generally. And so slide number 1 in that category, civilian unemployment. Well, when you look at, you turn on CNBC, they're usually talking about the U3 unemployment, the key unemployment number, which is going to be, like 4.3%. I like to look at this one, the U6, because it includes people that are employed part-time for economic reasons. And so when things start to get rocky, right, go back and look at the numbers from the Great Recession. This started to deteriorate before traditional unemployment started to deteriorate. If we were looking for a recovery, this would generally be where we start to see the numbers shift first. And so U6 unemployment, I'll highlight that, look at this, it's exactly where it was 1 year ago, 7.9%, 7.9%. B, you can see that that shocking ascension. We had one missing value that will never be during the government shutdown, but we went from 8.1 to 8.7 in that cloudy 60-day window. And so that was very alarming to see towards the end of last year. But since then, we've seen a figure that's kind of repaired itself, which is really interesting. A general decline over almost all of 2026 to get us back to where we were a year ago. And so we're not seeing a ton of weakness, even when you talk about people that would like to be working full-time but are stuck working part-time. Aside from a recent tick up in the June 1st number, initial jobless claims have generally been on a decline for the last 15 months. And so we stretch this one back a little further to show the history, and you can see there a general decline followed by a more recent uptick, but still just uptick into recent historical norms. And so this is people filing for unemployment for the first time. And we've actually seen this improve. I like to highlight this because this is one of the first things that economists look for when they're looking for weakness in the economy. One other that I want to go through, job openings versus unemployed. And so what we're doing here is saying how many job openings are there in the country and dividing that into how many people are actually hunting for jobs in the country. And you see, this has actually also improved itself over the course of 2026. We want this value to be higher. We don't want there to be more unemployed persons than job openings. And we actually see the strongest value, 1.04. The strongest value that we've seen in a year inside of that metric. And so a gradual decline followed by a gradual repair. And so that's one of the reasons we're looking at strength of consumer. And like I said earlier in the video, that started the month at a -1 and is actually, then went from 0 to 1 to 2. on a scale of -2 to +2. And so we've seen almost surprising strength in the labor market so far this year. One area of concern, this is only quarterly data. We don't get this as often as I would like, but this is real wage growth. It means wage growth above inflation. So you can see down on the inset graph, 2022, 2023, that had turned negative. It doesn't mean wages were declining in the literal sense, but when you take, when you're only looking at what they grow above inflation, it tells a pretty important story. Well, we've had, since that kind of 2023 pocket of mass inflation, we've seen wages grow faster than inflation for 12 straight quarters now. We do have this most recent value, which is a little concerning. And that has a lot to do, a lot more to do with inflation being persistent than it does with wage growth weakening. I haven't really seen any statistics that say wages are declining. But we have inflation that continues to be a concern. This is one of my only negative points in the stock market right now, or I guess I should say in the economy, is we have this wage growth. Inflation that's actually climbed over the last year. It's not just one bad data point, right? 2.8% a year ago, 3.4% today. So it's not that we have a conflict in Iran, oil spikes in terms of price, and so that explains the inflation. No, we've seen a reassertion of inflation over the last year. Um, and that doesn't necessarily have to be zero. It doesn't even have to be back to 2% to have a healthy economy. You can have a healthy economy growing with inflation. But this is one of the only things that I look at it and I go, ooh, that really started moving in the wrong direction on us. And you're not going to see a lot of additional rate cuts, I mean, Federal Reserve rate cuts, until we see some improvement in some of these inflation numbers. Last thing I want to look at for today, I know I'm going kind of long on my targeted time, but I wanted to walk through manufacturing and then services PMI. These are simple graphs to digest. Over 50 means a contraction, a growth, I'm sorry, an expansion. Under 50 means contraction. Manufacturing had been in a recession, just that sector of the economy, for 2+ years, right? And then all of a sudden, magically on January 1st, we saw this complete reversal where all of a sudden the indications were expansionary. And so we've seen 6 quarters. Yeah, 6 quarters now of that above 50%, where before that, in the prior 2+ years, there was only 1 month that was above 50%. And so we've seen a huge turnaround in manufacturing. And then we've also seen continued strength in the services sector. The services sector is a much larger part of the economy than manufacturing was. It has been growing for the last 2 to 3 years, but we've seen some very strong numbers in that area as well too. And so that's another area where macro actually looks pretty positive. Just a couple of summation things. I do like to break into a T section. We've talked about as many of these relevant things as I can, where we look at market positives, neutral indicators, points of concern. Under points of concern, I mentioned inflation already, and so I won't repeat myself there. Consumer confidence continues to be extremely negative, which is interesting in the face of what's generally a good but not a perfect economy. The dollar weakened a lot earlier this year, but has recently strengthened again. And we've seen business loan delinquencies climb a little bit over the last year. Those are the only negatives that I have on my T chart, saying, okay, what's good and what's bad in the economy. Some of it's neutral. My list of positives is still much larger than my list of neutrals. And so I'll do just a couple summation type items. My expectation is that we'll get to this next earnings season in July, and then we should be hopefully back off to the races in terms of stock appreciation, because I'm expecting some of those numbers to be really good. You can already see money rotating into financials and some of those other sectors where people are starting to place their bets and say, well, if financials, I think off the top of my head, July 14th is the kind of start of earnings season because Citigroup, Wells Fargo, and JP Morgan all announced on the same morning. And you can see money rotating into financials. And so people think the numbers are going to be good. Could end up being a disappointment. I happen to think that following one of the greatest quarters we've ever seen in terms of especially earnings per share um, growth, kind of net revenue growth, I'd be surprised to see some significant reversal, one quarter later. And so I think if you're betting, you're looking for appreciation in the stock market to continue in the second half of 2026. We've had a decent run already. The economy looks generally strong. There are some points of weakness. Housing starts as a concern, but it has been for a lot of the last couple years. New housing inventory, inflation is a concern, but it has been for a lot of the last couple years. But employment continues to be good, and the economy in general seems to just be kind of humming along right now. And corporate profits look great. There will be some rebalancing that people will probably want to do in terms of rotating a little bit out of small cap stocks. Who knows if that magic can continue, even though it's been pretty good for us so far. And rotating maybe into some of these more boring areas, financials, things like that, that people are really starting to take a look at. So I think that's enough for today. I hit 20 minutes. I apologize. I usually try to keep it closer to 15. But feel free to reach out if you have any questions. I appreciate your watching the video. And make sure to check our website, lifetimeretirementpartners.com, for additional content. Thank